Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I'm here with two of my favorite people in the industry, Todd and Kim from Truth Concepts. And today we are going to be doing what I think is going to be a fun video on how whole life insurance is actually, in fact, a better bond. So before we get into that, what I want to do is kind of set the stage as to why we're doing this. Like I did a video, it was a couple years ago, and it was all about how whole life insurance is a better bond. It was a short video, and I got a lot of pushback and a lot of people fighting with me, being like, Chris, you're an idiot. Whole life insurance doesn't really, like, it's not that good because I could put money in a high yield savings account and beat your garbage whole life product, right? Like, that's what people are saying at this point in time. And, you know, Kim, Todd, we all know, like, how this works from a long-term perspective. And sometimes people just look myopically at this one little environment we're in, and they don't think about the long-term effects of it all. So I thought it would be really fun, especially after the last training video we did for the Life 180 agents, like behind the scenes, to do a video that would be public on the Life 180 channel, showing how, in fact, whole life insurance is a better bond, and it's a better bond with benefits, right? Which is cool.
Right.
Right.
So
I'm
great. This is a fun topic.
I'm going to turn it over to you and let you run pilot on this because you guys are awesome at this.
Well, this is fun because what I like about it is it really shows that there's a lot of rhetoric that's just not true out there in the marketplace. And you know, so I ran an illustration, again, looking from now, dividends under current assumptions out into the future, which is one of the lowest dividend times we've had. So it's really not completely fair to the whole life side, because if we backed up and looked at what happened 35 years ago, life insurance dividends were way higher than they are now. But we're going to just assume that the life insurance policy performs as it is from now in a low dividend period out into the future, and compare that to what's happened in other areas that had advantage of better financial environments back in the past. And so we'll look at that and see how that compares. So if we just pull in a life insurance illustration here on a 35-year-old, and it shows that it would grow in cash over this time frame based on, again, current actual performance of the policy out into the future, $770,000 of cash value, and the death benefit would grow from $382,459 out to $1,247,718. And so if we look at that over time, what would it take if we put money into an account, $10,000 a year? What would we have to earn to get to $770,000? Well, it turns out that if it was the same earnings every single year, we would have to earn 4.03% every year to match what the policy does. Now, a life insurance policy doesn't earn 4.03 every year. What it does is it has a much lower amount in the first few years, and it earns more than 4.03 on the back end, so that it does an overall of 4.03. Not an average, but an actual return of that 4.03. And you can look at that and say, well, you know, I could do a bond at, say, 4.5%, and it's going to outdo this, right? So let's take a look at that. And so if we switch over to this alternate account and assume we had money, the same $10,000 a year, but go into a 4.5% account, and we'll look at the alternate account instead of the life insurance at 4.5%, then yeah, there's $851,000 over this time frame. So that bond doing 4.5 every year would outdo the life insurance policy, except for one thing. There's costs associated with the bond that have already been taken care of when we look at the life insurance policy. Those costs are taxes and fees. And so if we look at taxes on this bond of, say, 24%, if somebody's in a 24% marginal bracket, then all of a sudden that took away quite a bit. We actually have now $100,000 less than what we would have in the whole life policy, even though we're earning 4.5% every year, because the taxes that came out of the account and the growth on that would pull it down below what we have in the life insurance. And now if we added fees to this as well, and say 1.5, I know you had done some research and they're showing that overall everybody's paying what, 2.1?
2.1 according to Forbes. Yeah.
If we do 1.5, we can see, wow, that knocked us down to 495,000. And it shows that at a point and a half, we would actually have to earn 7.42% on the bonds just to keep up with the cash value in the life insurance policy. And we're not even talking about the death benefit. I know some people say, well, I wouldn't want the death benefit anyway, but that's a huge benefit that, you know, if used correctly, can strategically change somebody's spending ability out during those distribution years.
Well,
but
top of that though, Todd, like maybe some people might not want the death benefit or might not care about the death benefit, but I don't know anybody that doesn't care about having the living benefits that would come with it.
That's exactly right. And it's a great point. But you know what, those living benefits haven't been explained to a lot of people, and we need to go through those strategies to really see how big that impact is, right?
Yep.
So here, $495,000, we'd have to do 7.42. I don't think we're going to see that. You know what we could do is, let's go ahead and bring in the term insurance.
Okay.
And let's say that we did want to have the same protection for our family. We would have to buy term insurance. And if we did that, if we bought $380,000 to have it try to keep up at least the first year with what we would have automatically thrown in on the whole life insurance, that would be a $692 premium, actually, until we get down a ways. When we go down to that, because this is a 30-year level premium, once we hit that 31st year, if we want to keep it, it's going to jump to $13,000, almost $14,000. So, you know, most people would cancel the insurance then.
Sure. For sure.
And when we do that, now we see it would take 7.84 to keep up. Let's look at this on a chart for just a minute, Kim. And we'll get the index in here. And let's turn off the legacy, or the death benefit portion. We'll just look at the cash value growth. So here we can see what would happen if we had a 4.5% every year bond, is that gold line, and then the blue line is actually what the whole life insurance did, assuming again that we didn't have any increase in dividends, that they were exactly the same as they are today, all the way out.
Wow. That's
in this
cool.
low dividend time. Pretty amazing, right? So a lot of people would say, well, I think my bonds could do more than that.
Yep.
Right?
Sure.
Right? Let's get a bond index. Would that be fair? And look at the last 35 years of what, say, the Dow Jones Composite Bond Index has done. That's been one of the highest. It's certainly beat treasuries, right?
Okay. Yeah. Perfect.
All right. So if we take that, and we put that in place of the 4.5% every year and turn off the tax credit for losses. Now let's look at our chart. And we end up at about the same place as we did with the 4.5%, except it's less predictable along the way, right? We have a lot of ups and downs and rounds.
Yep. Yep.
So,
and that's a real apples to apples. But like you said, like, so there's a couple things here that I think are important. And I just want to reiterate this is like, this whole life curve, this blue curve that we're looking at for whole life is assuming that we're kind of participating in the lowest dividend rate environment in whole life history, right? Like for the past like 80, 90 years. And so taking that into consideration and then realizing if we were to overlay, and we can't do this, right? Like it's so apples to apples, it's impossible to do. But if we were to be able to go back and overlay the dividend rates on a policy that would go 35 years overlapping this, well, dividend rates in like 1989 were like 8-9%, something of that nature. So if we were to look at that, these numbers, like whole life would be, when we compare really apples to apples for the same time frame, would be off the charts comparatively speaking.
Correct.
Right.
Yeah.
And so we're taking a pretty good environment overall. There have been low years and high years for the bond market, and comparing it to like the lowest market ever for whole life insurance, and whole life still wins. Fair enough.
Yep.
I just want to make sure I'm really clear about it, explaining that.
You're right on track. This is not fair to the whole life piece, because it would be way more than this if we had the actual dividend returns that occurred over the last 35 years.
It's like
yet
we're
the bond.
handcuffing whole life and making it hop on one foot and it still wins.
Yeah, and not just a little bit more, but almost twice as
Right.
much more,
Yeah, yeah.
right?
It's awesome.
And on top of that, so not only is this great from a cash standpoint, and and one of the things that's left out on that blue curve is the fact that we are not even talking about what we could do with that access to cash, because we have it in a place that we can instantly get it and make an investment in real estate or some other deal that comes along that maybe is a once in a lifetime deal. So this is kind of minimums of what we can expect on this. We really don't have that flexibility on the bond side for using the cash. But then that death benefit that's thrown in with the whole life insurance for these same costs, let's just look at the legacy instead of the cash here. And this is what happens from a protection for our family across this time frame. This purple line is our whole life insurance death benefit continuing to grow, and it'll continue out. This is only out to age 70. And yet, look at what happens on this gold line if death were to occur along the way. See, once we get to that age 64, the term insurance goes away because we can't afford it anymore, because that huge jump that it made from $690,000 or $690 a year to almost $14,000 a year. So it drops there, and the death benefit basically, this individual is self-insured. And I don't know about you, but there's a reason I have my car insurance and homeowners insurance with an insurance company. It's because they know a whole lot better how to insure things than I can do personally. I would much rather shift that risk to an insurance company, right?
Oh, absolutely. Now, do me a favor here real quick. Just can you put the cash back on as well at the same time?
Yep.
Just so I can look at it. So like when we look at this, because you get to have it all, right? Like, I mean, you're paying the $10,000 a year instead. Like at first, if like, to me, this image tells a story. Like at the beginning, the bottom two images, the gold and the blue, you got that like crossover point, obviously at year 15. So there's going to be a little bit of cost. And this, this is like pretty much almost a full base policy, it seems like, or a blended policy, but not like what most people would consider like a banking policy, right? So we're looking at just the long-term perspective. And so, yes, there's that short-term cost that goes with it, but long-term, look at how you win. And then what is that gold line? That's the gold line below. That's the death benefit drop off of the term insurance, and like the combination of the term insurance and the cash value. Is that the deal?
Yeah, when it drops off at 64, what happens is our legacy now just becomes the cash and the bond. Basically, it's the same line at that point in time.
Right.
Right, because the term insurance is gone.
So the cool part that I'm seeing here is like, and this is where whole life insurance becomes a better bond, is because of how you can utilize it as a buffer asset. And the fact is, like, if you look at the bond return there, where, over from 67 to 68, 69 there, you see 67 to 68, it goes down in performance, right? And the bond market's actually lost. So when you look at the 60-40 portfolios that everybody's been relying on, if you're relying that, they always say you never want to pull from a negatively performing asset. And historically speaking, the reason people do 60-40 portfolios is because that bond theoretically is supposed to perform when your other equities are going down, right? So now we have a scenario where the 60-40 portfolio is busted. So, and the reason it's busted is because now it's been proven that bonds can lose the same years that equities lose.
Yeah.
Right. And so if you can't rely on that, wow, that is like absolute doomsday for people in retirement that are relying on that bond to actually do what historically they said it would do. And not only did it happen 1 year, but it basically happened 2 years. And now we're talking about like the fact that whole life is basically going to get you bond-like equivalents, but better, as we're seeing here, and a lower standard deviation, right? Like, so now you're not going to have a situation where, like in retirement, when you need to lean on it for income to allow your other assets to recover, you're like, the insurance company is saying, we're going to give this to you no matter what. Like, you're going to have a positive return. We've paid dividends every single year for 110, 120, 150, 180 years in some situations. So we're going to pay you that every single year no matter what. We'll take that short-term risk on. And that's kind of one of the benefits of having your money with us. So from like as a bond alternative, especially when we hit income planning and distribution planning with all of our assets, to me, like we're looking at this from an accumulation perspective, but it gets even better when we start talking about distribution.
Right. Well, see, even if the insurance company didn't pay a dividend, the cash value is still guaranteed to increase every year. That's amazing. It can't go down contractually. Right. It has to increase every year. And yet we see the bond and think about the impact when we had this drop, like you were saying out there, and obviously it'd be worse during the distribution phase, but keeping that 60-40 split means not only did we lose money here and we lost money in the equities, we probably had to shift money from the equities to the bonds to maintain that 60-40 split.
Amazing. And this is where the old permission to spend kind of comes in too, is because you could see here, like if you have this death benefit on the top side of just over 1.2 million, and then you have your other assets, whatever they are, like in the life insurance side and the cash value on the life insurance side, you're looking at 700,000. Even if you had to spend that money down, whether it's like through partial surrenders or loans or whatever, you're still going to have $500,000 of death benefit above and beyond it. Whereas with the bonds, if you spend it down, you're passing on nothing.
Correct.
Right. And so it's like so much more efficient in every capacity. How do people not see this? That's what I want to know. How do people not see it?
It's because, again, there's so much misinformation in the marketplace about the way this works. Everybody's just accepted this idea life insurance has a terrible rate of return without actually looking at it. And, they do what you said. They look at these first couple of years on something that's a long-term product. So really, you would rather have a little bit more money on the front and give up all this we have on the back? What was the point of saving the money? I thought it was all for what's in the back during that retirement phase. Right. and here's an interesting thing, and we need to look at this maybe on a future video, but it's interesting the way losses work. You can kind of think about this, but if you're going to have losses, you want the losses up front. You don't want them at the end. Okay. So a life insurance policy is designed perfectly for individuals. If it's going to be behind or have losses, you want them in the beginning, not at the end. The more money you have in there, the bigger impact a down year is, right?
Yeah, absolutely. Absolutely. Yeah. And especially, I mean, you could see that's a whole different video, like you said, but it's like sequence of return doesn't really matter until you start needing to pull money out of it. Right. And then the reality is when you're going to need to pull money out of it is later, when the costs are bigger, when you're in retirement, when you have no more income to put into it. And so if you have losses later, you need to have an account like whole life insurance that is guaranteed to not go down. Otherwise, you're way more exposed. And that's the challenge, is like there's so many people that, are sold on this whole just accumulation methodology of retirement, and they're thinking about saving and growing this bucket of money. And very few people focus on distribution planning and understanding what it looks like to unwind all this savings that we're doing, and all this investing that we're doing, when it looks to saying like, all right, what's that going to create for cash flow? How does that unwinding period or distribution period look like? And that's the way I look at it, is like, the whole life insurance, you're a little bit behind on the front end, but look at the benefit on the back end. You're going to have more cash, you're going to have more legacy, you're going to have more predictability, more stability, more protection, more living benefits. Like, and like like I said before, the bond, the 60-40 portfolio has now been proven to be a broken model, or at least not as dependable as it was once thought.
Yeah. One of the things I want to add to your list of what we have out there at the end, and it's options. That's one of the biggest things I think that people need to understand is, do you really think that the financial environments 35 years from now are going to be the same as they are today? I mean, we don't know what that's going to look like, right? And so most people, most advisors put people in a box that they don't, that's based on today, and they get out there in the future and they don't have any wiggle room, right? They're stuck in that box, and they have to they have to succumb to whatever the financial markets are. What we want to do with life insurance is, if we have access to that cash, we're in a position to shift based on whatever the market dictates is going to be our best option. And so that's a big piece of what we have in here. And that's the importance of that liquid cash, right?
100%. I love it. I love it. This is amazing. And I would say anybody that is watching this, if you haven't utilized Truth Concepts, you guys got to check this out. This software is just amazing. It's been a long time, like I leaned on calculators a lot, right? I leaned on like early in my career, and I'm just gonna say I've been lazy about it because I try to not like, and I think the reason though is guys, like for me, I try to not like lean on the numbers and the illustrations. I
Yep.
try to get people to understand philosophically and principally and like all these different things, and that's how I've kind of preferred to sell at this point in time. And then occasionally, if you need to pull in a calculator, I do. But like, I think obviously that's harder to get to get to the place where you can sell like that, right? Like, and I've just done it. You guys can do it without the calculators, but like, why? Like, they'll build your belief, and like I
Yep.
think numbers are proof. We always say math and money math are completely different, and Truth Concepts is going to show how actual money math works, right? Like, and how it will impact people's goals and objectives long term. And this is awesome. I mean, I don't think anybody. So this is my mic drop to all you trolls out there that are telling me that bonds beat whole life. So watch this, and I can't wait to see all their comments now. I'm going to link this video on my other reel at the top and pin it to the top so they can see it.
Cool.
Awesome.
This was
Well,
fun.
thanks, guys. That's
Yep.
amazing. Got anything else we want to add to this, or are we're going to land the plane? We're good?
I think we're good right now, don't you?
Okay. Yeah,
Yeah,
no. I
we're-
just did.
We're
You know,
pretty
it
good.
is. Oh, go ahead.
No, you go.
I was just going to say it is amazing what you said a minute ago about, you've gotten into a place where, you understand how all this works and you kind of backed off the numbers. And I have gotten to that place. What's interesting is somebody will bring something up and I'll pull up calculators to prove it's like, holy cow, look how this works. I mean, it still amazes me today how whole life insurance is so multifaceted, and you start through it and it is amazing how all the pieces integrate on a big scale. But I think the big problem why people don't understand it is because it literally takes a chapter to be able to explain all the things that a whole life insurance policy does, right?
And it can be overwhelming for sure.
You can't do it in a one-liner.
Nope. Then
But you can do everything else, right? Look, my bond beat this whole life insurance policy in the first year. Oh, okay. Well, I guess that's good.
Yep. Yeah. And that's where this, like, unfortunately, this microwave mindset and this, Instagram reel culture and TikTok culture has kind of like really hurt the financial space, I think.
Yep.
And that's a challenge. But like, think about it this way. I love Brendan Burchard. You guys know who Brendan Burchard is? So
Yes.
he's a high performance coach. He always says in his training, I went through his high performance coach program, and he always would say, Chris, common sense is very seldom common practice.
Yep.
And like, if we get out of all the numbers, all the illustrations, all the calculating, we just start thinking about whole life insurance, and we go, whole life insurance has stood the test of time for 180 years in its participating mutual form the way that we have it, right? Like, so when we break it down and we look at all the other strategies, all the other investments, the fact that all these companies come and go, all these banks fail, and like we've had 3 different versions of the dollar ever since participating mutual whole life insurance companies have been around, and they've weathered the transition with every dollar. They've done all this stuff, and it's like, that doesn't happen by accident. Like,
No.
you know what I mean? Like, this is.
But here's what's amazing. Here's what the financial media has put on people. This is kind of, it's not necessarily new, but what they say is that's an outdated asset. Isn't whole life insurance now? It's like, no, it's actually still here. That's the whole point. But they're looking at it as, oh, that's old hat. That's there's nothing flashy and new. And so they've turned that twist, and I think it works.
Yeah, unfortunately, people fall for it, right?
Yeah.
Because if they don't understand, I mean, at the end of the day, it is complicated. And I think this is why IUL sells more than whole life right now, because of the fact that people are just taking an illustration. Doesn't matter if the illustration is worth the equivalent of toilet paper. Like, they're buying off of the illustration, and it's easy if you don't know what you don't know to look at that and be like, oh, an insurance company is putting this on paper, so it must be conservative. There must be some level of morality to it. I think that was my conversation with Bobby Samuelson that I did with IUL, and he said, listen, it's not that IUL is good or bad. It's like it's
what it is.
The biggest mistake that people make with IUL is that they look at the illustrations, and because it's an insurance company putting numbers on a paper, people assign a level of morality to the numbers when in fact there is none. And that's what he said, right? Like, so
yeah, that's amazing.
when you really think about that, it's like, no, these insurance companies that are doing IUL for the most part are stock-based companies driven by a profit, and their alliance and allegiance and obligation is not to you, the policyholder, it's to the shareholders of the stock company and to turn a profit for them, period. And when you look at the moving parts in it, like it's you can't compare. Like, and when you look at whole life insurance, they're going to stand the test of time. And like, to me, if I'm going to put money in an insurance company and into an insurance policy, I want to partner with the companies that have my back, that I can actually know that if they're around, I'm going to be around. My policy's good. I'm safe. My money's safe. And I get a lot of pushback, not pushback, but questions from people. Like, I had a conversation with the guy yesterday. He said, Chris, I'm doing this big policy. I'm worried about the dollar. I'm worried about, all this stuff. Like, I'm still dealing in dollars, when we put money into a whole life policy. And I'm like, listen, man, like, I'm not going to sit here. Like, I don't play that game, first of all. Like, but I will say this, if you are in fact worried about the dollar, do you question your ability to manage the transition to whatever currency that we're going into? Or do you trust these insurance companies that are managing billions and billions and billions of dollars, that their biggest customers are like really wealthy people, corporations, banks, like all these people that are relying on the stability, like whole life insurance companies are really the foundation. Like, when you look at BOLI, the foundation of a lot of the banks, right? Like, so
yeah.
If you look at that from that perspective, do
Everything.
you have the ability to manage that better than these companies, than a whole life insurance company? Like, let's just say that the dollar did get, debunked, or like we lost a world's reserve currency status, or something crazy like that happens, right? Like, I don't think it's going to happen anytime soon. I really don't think that'll happen anytime soon. But if it did, do you think you have the ability to manage that risk? Or like these fund managers making tons of money that deal with billions of dollars and are dealing with managing some of the wealthiest people's money and wealthiest corporations' money in the world? I'll put my money with them and trust them 100% of the time. I think I'm a pretty smart guy, but like, I'm not that smart.
Well, and quite honestly, the bottom line is, if that's what you're really worried about, then you just need to buy food. I mean, that's the only
guns and ammo, baby.
That's it. Gold's not going to help you. Nothing is going to help you.
Water.
Food, guns, and ammo. Let's go.
Yep.
No. So, all right, guys. Well, that was a fun ending. But if you guys haven't already, make sure you subscribe and hit the bell, that way you're notified every time we launch a new video. Also, I'm going to put a link in the description below. Go and subscribe to Truth Concepts. Not only are they a calculator, they actually create their own content as well. So if you haven't subscribed to their channel, make sure you do, because they put out really amazing stuff, like educating to the X's and O's and numbers of this stuff as well. So till next time, hopefully you found value in this. Have a blessed, inspirational day. We'll talk soon. See ya.